technology is eating the world, and fintechs first disrupted distribution. And DeFi is disrupting infrastructure. And there is a very natural wedding to happen between the DeFi world and the fintech world in order to actually say, hey, by the way, all those fintechs that had amazing distribution that was plugging all of this into the TradFi businesses, we're actually gonna now switching to our own infrastructure. And then TradFi looks at this and is like, oh, we need to come on chain as well, because otherwise we're gonna lose, all the distribution that we used to have. And all of a sudden, everybody that used to operate into black box, with like pretty fat margins, to be frank, end up operating in an open environment where competition is actually fierce and where the value accrues to the edges of the network, which is the consumer, as opposed to like in a centralized backend of a banking infrastructure. And that's really what excites me about DeFi and about crypto in general, is like, how do we essentially take all the value at the center of the financial networks and how do we bring it to the edges?
Totally.
Right?
All right, here we are with Paul Frambot, the co-founder of Morpho. Paul, it's great to have you finally on the Defiant Podcast.
Hey,
welcome.
Yeah, thanks for having me. I'm really happy to be here.
Awesome. And at ECC, no less.
Yeah, no, it's a great weather. A bit too great, even like a bit too hot, but it's great.
So, Paul, Morpho has quickly emerged as one of the leading lending protocols in DeFi, and you've done that taking a bit of a different approach than other lenders. We were talking right now about you having between 4 to 6 billion of TVL, depending on how you count those numbers. So, yeah, would love kind of the backstory on what got you there. What gave you the idea of founding Morpho?
Sure. So I started as a student, actually. I was studying consensus algorithms, distributed computing in France, actually, in Paris. And this is what got me into blockchains, and then obviously crypto, and then DeFi, and then eventually lending. And so we started actually building on top of lending protocols. So we looked at Compound, we looked at Aave. We saw that there was an important spread between the lending rate and the borrowing rate. And our first protocol that we now call Morpho V0 was essentially a way to optimize the interest rate of the Aave by matching their users peer-to-peer. And so we built on top of Aave this protocol that got traction very fast. We got actually to $2 billion with this protocol. It was actually, I think at the time, the largest user of Aave itself. And this is our entry into lending. That was like 2-3 years ago almost now. And this first step had us realize that a few things needed to change if we truly wanted to be ambitious about on-chain lending. And this is what sparked the idea of what we call now Morpho V1, and which is the protocol today that has more than $6 billion of deposits, is the idea that the protocol should be permissionless, should be immutable, and it should allow anyone to actually create their lending products. So you can think of Aave as a fund, you deposit your money, and Aave DAO is going to manage it for you. Think of Morpho as an infrastructure for funds, where anyone can deploy their own funds. We call them vault creators, and today we have 25, and they're going to create lending products that could look like an Aave, for example, with a similar risk profile, but also something that could be more risky, much less risky, much more conservative, different compliance, different risk, different fees, etc. And Morpho just gets to provide the permissionless immutable infrastructure, and then risk curators and distributors end up building the lending use case that they need for their specific users, right? And so this way, we're quote unquote like more B2B, quote unquote, while Aave is more B2C. Like Aave would address directly the end users, while Morpho addresses like direct businesses. So for example, Coinbase uses for their loans. So if you take a loan on Coinbase, for example, it would use Morpho behind the scenes, but a bunch of wallets as well, like Ledger Wallet, Binance Wallet, Trust Wallet, Safe Wallet, for example. They all have their own version of Morpho that they deploy, that they configure to their specific use case in order to tailor to their specific audience.
So, and is this fully permissionless?
It is.
Any business or any individual user come to Morpho and create their own lending product?
Exactly. If you're like a Latin fintech and you want to create like a vault that generate yield on USD, Bitcoin, or like a local money, you can do that extremely easily on Morpho. But it's permissionless. So the fun story is that the first day on Morpho, we had actually like people trying to scam other users and create fake markets, which obviously at the application level were not shown, but like literally a few hours before we deployed the protocol, the same way you have on Uniswap, you have those fake pairs that are created. So it could range from anything, like the most like largest institutional like asset managers in the world could create markets as well as like a very degen use case, for example.
So it doesn't require Morpho to allow specific assets to be deposited and used as collateral. Like anyone can use any type of collateral.
We have zero control over the contracts. Contracts are immutable. Really exactly like Uniswap to this regard. I have no say in what token should Coinbase use, for example, right? And that's part of the value prop. Like Coinbase wants to own the financial infrastructure as well. And they want to be able to say, hey, like, we don't want to ask Paul if we can do one thing or the other. It's all permissionless, right? And it's the same thing for everyone in the protocol, yeah.
So that's a crucial difference with Aave, which does have to approve which collateral gets onboarded.
Yeah, you can think of Aave as something that could have been built on top of Morpho. Actually, Compound, that used to be a competitor to Aave, is now moving to Morpho. So they have Morpho vaults now that they run and that they use the Morpho infrastructure for, right? So they used to have like the Compound v3 protocol, and now the latest are Morpho vaults.
Interesting. So how do you manage risk? Because obviously, very volatile, low liquidity collateral could be added easily to Morpho. So how do you segregate those types of assets?
It's a good question. The protocol does not. The protocol enables anyone to create any form of risk, any form of compliance, etc. It's agnostic of the risk. It's the vault manager, the vault curator, whose job is to actually to decide, okay, what collateral asset am I going to expose my users to? What oracle am I, going to be using? What liquidation, loan to value, what liquidity, etc. And so we have specialized firms whose job is actually to do this, right? So for example, like there is the Gauntlet team, the Steakhouse team, like Ari7, Block Analytica. We have a very, very long list, MEV Capital. I could go on forever. Of risk managers, if you may, that deploy those vaults and whose job is actually to do the work, right? But the risk management piece has been externalized from the protocol. I don't get to have a say in how risk management is in Morpho.
So with these risk management teams, what measures can they take to protect end users?
Well, it's fairly there are a few things. Morpho in itself is a quite simple protocol, right? So you have to make sure that the collateral that you're exposing the lenders to is safe. Say, like, for example, WBTC, CBBTC, or STEs, ETH, etc. are recognized as like pretty safe, collateral in general. Then you need a safe oracle that you configure properly. That in case of like market downturns, like you are able to price accurately the assets, as well as a good liquidation loan to value. So you want to make sure that there is enough collateralization of Bitcoin in order that in case of there is a market crash and like Bitcoin price is divided by 2 in just like a few minutes, in an extreme scenario, you want to be making sure that the borrowers that are borrowing the USDC will be liquidated and that they will actually come back to repay because they're being liquidated. And so that's the job of the vault manager to do. But I think something that's important to understand is that Morpho is looking to have all the possible risk reward vault in the spectrum. So you could go very far down the risk curve and you could have something that's extremely risky if you wanted to, that has a very high yield. Right. And yes, maybe it will take some losses from time to time, but that's like the price of the risk, quote unquote. And so we don't want to be like, we want to be the infrastructure where you can build any sort of like lending product that you would want, right?
So your your vision is, like you said, a lot more B2B focused, and you are now, all about institutions, and it seems like it's the right time for that, or at least there seems to be a shift in crypto where there is more. Institutions are more open to exploring crypto and even DeFi. So would love more context from you, from how are those conversations going, from how has that developed, like from when you first started approaching institutions to today? Have you seen that shift?
Oh yeah, of course. So it's the shift is really, really incredible. Like it's been really impressive. Like a year ago, I was having already a lot of conversations with institutions, but it was much more sort of like research driven, talking mostly to innovation labs, and they were experimenting and building like internal knowledge. Nothing was business driven at all. And the main difference now is that there is so much money on chain that all those institutions see an opportunity, a business opportunity, not just a research opportunity. And so as a result, in those large companies, the people we get to talk to now are the business units, right? That have KPIs to match and that are actually driven by the outcomes, the product outcomes, not by like the experiment, right? And so this makes a whole complete new difference, right? Because you can actually start building very interesting products together with those institutions. And institutions is a broad term, but you have everybody ranging from like the exchanges, the fintechs, the neobanks, to the asset managers and the banks, right? So there's the wide spectrum of like from most crypto native to least crypto native. And good news is that DeFi protocols, especially when they're positioned as an infrastructure and permissionless, etc., they can serve all the risk and compliance spectrum, right? And so we get to work with all the spectrum, and there is interest from everyone. And at the end of the day, everybody will be connected in a single protocol. So that's very exciting.
So what types of use cases are institutions interested in right now?
So it really depends. Like, again, depends on what we mean by institution. But for example, if you're an asset manager, right, a large TradFi asset manager, well, Morpho is an asset management protocol. You can deploy vaults, you can manage funds, and expose it to different risks, etc. So that could be an interesting use case for them, right? Right now, when you look at TradFi, they are tokenizing a lot of stuff. But in practice, what does that mean? Is that they have a fund that is off-chain, running on off-chain rails, like traditional backends, etc. And they're just going to tokenize the share. And so they do this because there's a lot of money on chain, and they want to benefit from the distribution. But the reality is that it's really awesome, but it's still a bit of a Frankenstein, right? Because you're sort of plugging in the DeFi protocol a token was actually a representation of something that's highly complex on chain, right? The ideal world is that we bring the off-chain part on chain, right? And this is kind of like what Morpho is meant to be, right? Like a non-chain protocol that lets people actually manage funds, right? And risk on chain and compliance, et cetera, et cetera. And so yeah, to that regard, that's an interesting use case for banks, for asset managers, et cetera, et cetera.
It's okay. So it's interesting the framing, because, to me, Morpho is about lending and borrowing, and that's, I think, like if I'm not mistaken, the first major institutional use case has been Coinbase using Morpho for their users to lend against their Bitcoin.
Sure.
Right? Okay. But you're now talking about Morpho as like a fund infrastructure.
Right.
So say like BlackRock, which is they have, you're talking about like tokenized funds. They have their T-bill fund. How would that look like if BlackRock were to actually issue funds directly on chain on Morpho?
You're right. So I should clarify. Morpho is a multi-sided market. You have lenders, you have borrowers. So you have use case for both kinds of institution. On the borrower side, you have what we do with Coinbase, for example, where you can use the Morpho infrastructure to build borrowing markets for your users, right? And then you have the lending side, where you have to manage funds to allocate to borrowers, right? And so, for example, BUIDL is in some way a Morpho vault off-chain, where essentially the idea is that you manage a portfolio of bonds, right? And it's state bonds. So essentially, BlackRock gets capital and then allocates this capital to bars, and so in that case, there would be the state, or it would be a repo market, whatever. All of this could be, in theory, in practice it's tough, but in theory, it could be reproduced on-chain, where the MMF is, the money market fund is a Morpho vault that collects money and then is going to directly lend the money to a state, right? It could be through the form of bonds, whatever instrument. And the vault in itself becomes the MMF, right? And it's not some kind of like off-chain like instrument that gets tokenized on-chain. It's like the fund is actually running on-chain and is recognized like on-chain. There are obviously some regulatory like bottlenecks to have like securities recognized in blockchains without having to tokenize them. In the US specifically, in Europe, you can have like you can have more and more like especially in France, we have like some regimes that allow you to mint like securities and those kind of funds directly on chain without having an off-chain representation. Everything can be done on chain natively.
Interesting.
So
yeah, because like that would be then like the next step after real world assets.
Exactly.
Right?
The PR Genius is a top crypto PR and growth marketing agency, helping brands globally with expert PR and strategic growth marketing. They've worked with 300 plus projects like Movement Labs and IO.net. Unlike traditional agencies, they charge only on performance. Their services include earned PR opportunities and marketing services to help boost wallet holders and organic X followers. Learn more at www.theprgenius.com.
RWAs are all the rage, and everyone, is talking about like tokenizing assets off-chain to represent on-chain.
Exactly.
But this would be like a step further, like bringing issuing assets directly on-chain.
Yeah, no, 100%. Like native issuance, or we need a name like we have for real world assets, for those kind of things. But having the actual other side of the market, so usually it could be credit, it could be state bonds, etc. Having them natively issued on the chain would be really like the key unlock to have like all TradFi actually porting their technologies on chain. And so this is what I'm personally excited about. It's a bit, as you said, a few steps forward after tokenization as we think about it right now. But it has to be the future. It has to be the next step, because that's what's going to unlock the most, amount of efficiency, network effects, etc. To have everything in one single state machine, which is the blockchain.
Do you think like the logical first step for that is like equity on chain? Like if companies started just like issuing their shares on chain without having them ever be off-chain.
That would be awesome. So I think the first example we've seen of that, if I'm not mistaken, has already been live from SocGen. So SocGen is a French bank, and they're leveraging this pilot regime for DLTs in France that allows them to mint securities and debt instruments whose registry of ownership is the blockchain. And it's natively on-chain, and there is no such thing as like an off-chain registry for those, right? And experimenting with those kind of like regulations, I think it's super important to be able to welcome like, all the securities on a decentralized ledger. And, we definitely see that this is where the world is going. Like if you look at what Robinhood announced yesterday, for example, it was, they're launching like their stock tokens on Europe. And this is definitely the direction. So in the case of stock tokens, it's still a representation of something that's off-chain, but eventually that would definitely be the direction, I'm guessing.
Super interesting. So, okay, let's come back to the present. That's like a very futuristic vision. So you're seeing lots of interest from institutions. Can you reveal some of the I don't have names, but like implementations that we might see on Morpho coming forward?
Well, I obviously can't give names specifically, but I think general idea is that what we've done with Coinbase, which I think is truly amazing in the sense that it was the very first time that we were giving access with Web2 feature parity like the users, the 100 million users of Coinbase have no idea that Coinbase Loans is a DeFi product, right? And they should not be aware of that, right? The only thing is that when they perform their loan, at the very, very end, it's written powered by Morpho, which is the only sign that could make them guess that this thing is not like, is there something more to it? But it's truly amazing because now Coinbase is able to access global liquidity outside of the Coinbase ecosystem. Like the lending liquidity that the bars are taking is coming from outside of Coinbase. It's actually coming from other fintechs that are depositing liquidity into Coinbase, right? Which is crazy, right? Because now Coinbase uses Base as a global backend that connects liquidity from many different sources. And I think this integration end-to-end from the chain to the protocol to the tokenization of BTC, gas abstraction, wallet abstraction, passkeys, etc., all that together was what was needed to prove that you can build better products on-chain with feature parity with Web2. And this inspired a lot of other people.
Interesting.
Right? And I've been very, very impressed by how this was embedded into the pitch deck of like every single bank, every single asset manager, every single player I've been talking to is, oh yeah, Coinbase, Morpho, Bitcoin loans. And this has been really impressive. And even for Morpho, it was a true 0 to 1, right? In terms of like how fast our conversations were moving. And so sort of like the playbook for us has been like, hey, how can we replicate this playbook with other players and build this global network of liquidity in which you have obviously Coinbase, but also like other fintechs, other exchanges, etc., that could do the same, and even like more institutional players that come together in like one single network of liquidity that's going to benefit everyone, right? For example, Coinbase would be like super happy if we can bring on more lenders coming from other, venues that could even be their competitors, right? Because that would bring them more liquidity, so better pricing, better efficiency, etc., etc. And so that's what we've spent most of our time in the last 6 months, I would say.
It's so interesting how using DeFi as a backend to fintechs or banks can unlock so much. Like just instead of having one closed company, one walled garden, like you said, you now Coinbase by integrating DeFi in the backend just has access to like.
That's awesome, right?
Like just like a global liquidity that wasn't possible before.
It's actually the title of my talk tomorrow at ECC is DeFi is the backend for fintech, and goes through essentially the 4 reasons why you want to use DeFi as backend, which is number 1, you said it, is global liquidity and global accessibility of like that gives you like so deeper liquidity, better pricing for your end users. The second one is it's super easy to integrate. Like it's all open source. Like Coinbase open source some of their integration code for the Coinbase Bitcoin back loans and other stuff. And so frankly, like now with AI, you can spin off your neobank application that plugs into Morpho in like literally a day, right? And that to me, that's
crazy.
insane, right? Yeah. Number 3 is transparency. And transparency has been a bit like the meme where people don't really care that much as the end user. The things are transparent at the end of the day. And this is something we've been repeating over and over as an ecosystem. That said, in the case of crypto back loans with Coinbase, well, if you take FTX, for example, a lot of people got burnt, right? By, they deposit their collateral in the thing to take a loan, but they'll never see their collateral again because it was rehypothecated into Alameda, for example. And so having the chance to, how should I say, Coinbase is now able to prove to everyone that every single dollar of Bitcoin that is deposited in this use case happens to be in self-custody of every user in the Morpho smart contract. And you can verify that. You don't have to take Coinbase for their word for it, which is really incredible. And the 4th reason is ownership. And so what does that mean? Well, Coinbase and all those fintechs, like they own distribution, but they don't own, in many cases, the infrastructure. Like if you are Robinhood or if you are Revolut, etc., usually you would rely on a bunch of other partners, brokers, etc., in order to operate your financial services. You don't own the financial service yourself. And what's awesome about Robinhood Chain that they announced yesterday is that they're moving away from not owning the infrastructure to actually owning the infrastructure, right? And so now they'll be able to build, financial products end to end from distribution to infrastructure that they can shape into whatever they want in order to build the best possible product for the Revolut or the Robinhood user base.
Right.
And to me, that's really exciting. The fact that they can rely on immutable code, that they have to trust no one, and they can, build the financial product that really makes sense for them is one of the key value proposition of DeFi.
For sure. Okay, but in the end, all of that, they're great benefits. But in the end, users will obviously look at what's the most profitable.
Yes.
How do DeFi rates compete with TradFi or Fintech rates?
It's funny because I got a few calls from lending desk in the last few months. And the guys asked me, hey, how come retails on Coinbase app get 5% out of their loan? Well, institutional rates are at 8% right now. And I'm like, wait, how do you get 8%? That's very, very high, right? And it's like, hey, look at my book. So they have their internal trading book and stuff. And I see the orders, and the reality is that because those books are closed, there is no competition, right? No one can come in and say, hey, 8% is too much, I'll take it, right? Whereas in DeFi, everything is open. So the competition is truly, the market is so much more efficient, because if for example, Coinbase borrowers starts to pay, 6 or 7%, lenders will come because the opportunity is visible to everyone. Whereas if you have a private OTC lending desk, no one knows there is an 8% opportunity of Bitcoin secured lending. I would take it. It's a good yield, 8% for Bitcoin backed loan. It's a very safe product. And so the fact that everything is open unleashes a very strong competition between lenders. And this is what drives efficiency. The network effects of everybody can come together and arbitrage the rate in a way that's completely open is really what drives better pricing, better liquidity, better efficiency, et cetera, et cetera.
Yeah, that makes sense. I think on the crypto native side, the connection to DeFi is obviously a lot easier and very obvious, and it's kind of like a straightforward path. But what do you think is missing for more a traditional banks and fintechs even to actually use DeFi on the back end? From conversations you're having, what are some of the roadblocks that they're seeing?
Fintech's not so many roadblocks, frankly. Just execution and time now.
Okay.
Frankly, obviously exchanges even better. Banks is different. Banks still have much heavier regulatory requirements in order to operate. And so it's very tough for them to move into permissionless blockchain environment. For example, JP Morgan, I believe, are still using Onyx or their Parity blockchain for repo. And I think eventually everybody understands now. I think everybody now understands that permissionless blockchains are much better eventually, for the reason I just mentioned before, which is more open means more competition, means better pricing, means bigger liquidity, more efficiency, etc. So the more you can welcome anybody at one single place, the more efficiency you'll drive. And so everybody gets this, but there are still some regulatory roadblocks in order to be able for them to interact with permissionless blockchain. I don't want to talk too much about what those specifically are because I'm not sure, to be transparent.
Sure.
And also just as a fact that there is a lot for them to learn still as organizations on how they operate on chain. Now they all want to, which is great, but there is still a gap in knowledge and understanding, a gap that is tightening, is getting smaller and smaller. Fast. I'm very impressed, by the way, by the people in those institutions, but still a gap present.
Do you think is privacy a concern?
It's a good question. I think at scale, it will be for sure a concern. I think the time to market for privacy is not there though. Super, 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 super important, obviously. And by the way, I think this is like most of the focus of Vitalik. Like I think we were listening to Vitalik yesterday, and he would like emphasize privacy and the privacy roadmap for, like, you know, for a very at least like 10 minutes during his talk. And so there are really two kinds of privacy for DeFi. You have the anonymization of the address and the amount. So what does that mean? You are interacting with the DeFi protocol. All the transactions are visible, so someone can see that someone interacted. Can they know it's you? Can they know? So that's one first question. And the second question is like, okay, you can see that people are transacting. Can they see how much you're transacting, right? The first one is much easier to achieve than the second one. Second one requires like very complex cryptography in order to be able to like anonymize the amounts. It trades with the efficiency of DeFi protocols. It also requires to reshape completely DeFi protocols overall. The first one is much easier. It's much more of a UX thing. It's like, you know, you have this thing in crypto where if you have a payment in crypto, you don't want to share your main address because it's just going to leak your entire portfolio. So you would usually share a new fresh address, then receive the money, then send it to an exchange, then get the exchange to send to another account, or, you know, and this UX is a bit clunky. And there are solutions to be able to, like, you know, give just a name and like the system does the key management for you in a private way. This, I believe, is going to be needed sooner than later. The other part, which is anonymizing the amounts, much later down the path. Probably needed though down if we truly want to achieve scale for, like, you know, capital markets and institutional markets, etc.
Definitely. I think, you know, from my conversations, that's like concern number one with transacting in blockchains. Yeah.
What if sending crypto felt more human? Pulse just launched Red Packets, a new way to gift tokens with meaning. It's gasless, gamified, and claimable inside group chats only. Think airdrops meet social cues on-chain. Backed by smart wallet tech and live across major L2s, Red Packets turn communities into microeconomies of gratitude and growth. No seed phrases, no friction, just connection with value. Check it out at pulse.social.
Okay, now changing topics to the DeFi lending market overall. I recently did a piece for the Defiant newsletter that was, you know, looking at how the ecosystem has changed from the very early days. And it's really interesting because early days, it was basically Compound, Aave, Maker. And, you know, in the past couple of years, the ecosystem has become a lot more diverse. Like I said at the beginning of the conversation, Morpho has really been one of the kind of star emerging lenders. But Aave has continued to gain market share, even as kind of diversity increases. So your thoughts on kind of where that is going? Like, is it some sort of like network effect for Aave that's just like very hard to compete against them right now, or I guess like the pie just grows for everyone? But like, how do you view like competition in among lenders in DeFi?
Right. So I think Aave is an awesome bank for crypto users, right? Morpho is an infrastructure for banks for crypto users. And so to that regard, the long-term game of Morpho and the long-term game of Aave, I think, is very different, right? And if you look at both of our upcoming versions, which is Aave v4 and Morpho v2 respectively, it goes really in two very different directions, right? Morpho is going the free market route, where we're letting and unleashing completely like lending markets and letting the ability for any creators to price the risk of any asset, do fixed rates, et cetera, while Aave is putting even more under the control of token holders with bridges, et cetera, like interest rate models, whatever. And so what I mean by this is that I don't think we have the same long-term game at all in the same market, quote unquote. Aave, for example, is much more fully integrated as they do risk management and compliance management themselves. For example, they build like this Horizon, which is like quote unquote institutional product that allows people to tokenize their funds and use them as collateral to borrow USD, but it's an investment product that they manage, right? Horizon. Morpho is infrastructure for anyone to build this kind of use cases, and the hope on the Morpho side is that the persons competing with Aave are our builders, like the curators on top of Morpho are the one competing with Aave. And they've been growing a lot. And most interestingly, the curators of today, maybe they're gonna partner with the curators of tomorrow. And those guys are probably much bigger than Aave themselves, right? And so my point is that in the world where the number of tokens increases, and I believe we're like orders of magnitudes away of the number of tokens that we'll have on chain, you can't manage everything yourself. You have to open the floodgates to anyone to be able to do risk management, to be able to go down to under-collateralized lending and to do credit. You can't be like managing every single line of credit in the world with token holders. I don't think that's scalable. However, if you have an open system, it takes much more time. It's a much longer route. But then you build a builder ecosystem where people can manage funds on top of you and create actual businesses, hire people, and then all of a sudden you end up with 25 companies that are building on top of the Morpho network, reinvesting resources in the Morpho network, and that will constantly chase new risk and grow the pie, etc. So I hope it makes sense, but to that regard, it's like a very different like long-term game, and Aave has been doing great as a single manager model. We're the bank, they are the bank. And I think eventually some of our banks that are built on top of our infrastructure will do even better, right?
Interesting. That's a bold claim. How big do you think that the lending market can be?
Today in TradFi, just the repo market, which is overcollateralized lending with, let's say, treasuries as collateral to borrow cash, is trillions of dollars of volume every day, right? So Aave, I think, is like 30-something total deposits, $1 billion of deposits. Morpho is 6. We are very, very small compared to the size of what TradFi can bring, right? And this is why, again, I think the infrastructure play is really interesting, because you want the big guys to leverage an existing infrastructure to build their own thing that they own, right? And so whenever they come in, they will be the guys that make the most amount of volume in crypto on crypto rails, right? And so it's a $10 trillion market, like over-collateralized lending, right? Not even speaking of under-collateralized lending, which Morpho is also chasing eventually as part of like Morpho V2 and other stuff we're cooking. But yeah, and which is an even bigger market.
Yeah,
right. But that's another story, right?
Let's actually get into that.
Yeah.
I'm interested in your thoughts on how DeFi can get to unsecured lending.
It's a good question. I thought a lot about that, and I wrote a piece that I published like a few weeks ago, like 1 month ago, 2 months ago, that is called "The Price of Trust." And what this piece discusses is essentially the idea that for the last 7-8 years in DeFi, we've thought about protocols as as an entity that's going to issue loan in a risk-free manner. So what I mean by this is that we were thinking, hey, the role of a lending protocol is to issue a loan and to secure that loan and make sure that there is no loss of capital, right? And what we ended up concluding with Morpho is that it's not the role of the protocol to issue the loans, it's the role of the market, right? And that's also a main difference with Aave, right? Aave, it's the protocol issuing the loan, deciding which collateral is accepted. And so you take money from Aave, right? In Morpho, we provide infrastructure for the market to give a price to things and say, hey, I'd be willing to lend my USDC against BTC as collateral. And I would price this 6%, right? And so in the Morpho world, what curators are doing is that they're giving a price to a commitment of future value, right? So a borrower is making a promise and is saying, hey, I'm gonna come back with the money at one point. And so the lender is like, okay, why would I trust you for? Well, they say, here is some collateral. And by the way, you can seize it. And there is enough liquidity, you'll be able to liquidate it. Sometimes it's not true and it becomes under-collateralized, right?
Yep.
And so that's why the lender trusts the borrower and decides to give it a price, right? Maybe if they're not so sure, they'll give it like 10%. If they're very comfortable, they'll give it like 4 or like softer rates. And it's very important to understand that the interest rate is the price of trust, right? And trust is conveyed with liquidatable collateral today. There's really nothing preventing another trust assumption to come in. So let's say, okay, I'm Paul. I sign a message saying, hey, I would like to take, 100K loan at 25% to buy a house. If I submit this intent in the Morpho network, no guarantees, nothing, right? I think some curators would give me the loan. Why? Because they trust me, right? And so then they would have me pay the price of this trust, right? Or the risk of me not repaying, if you may, right? Obviously, that's a very weak commitment that I'm making. I'm just like on honor and on my reputation, etc. You could do much better than that, right? You start having identity primitives. So you could say, hey, here first, I can prove I'm a human. I can prove that, my name is XYZ. Or if I don't want to disclose my name, I could say, oh, I can prove that my risk score off-chain is XYZ. And also, here is a legal document under the laws of the US that states that if I don't repay, my credit score gets impacted, or those kind of things, right? Or maybe it's under the laws of France, whatever, right? As soon as you can broadcast this and you can show to the lender why you can be trusted, then the market, the curators can look at all of this and say, hey, okay, I'll give you like 25%, or I give you 20, etc. And the intuition here is that it's not for the protocol anymore to like algorithmically issue the loan for all those individual lenders. It's a market where curators can give a price to whatever trust assumption the borrower is bringing. Collateral being one trust assumption, but it's not exclusive at all. It could be much more than that, right? And so this is just the general direction. If you go the permissionless route, the free market route, which Morpho is taking, there is a very natural path to under-collateralized lending and credit, where the borrowers can, with identity primitives, with some like legal primitives, etc., you can bring trust. And we won't specify like a specific, legal like module or etc. It's just like, it could be anything. It could be under the laws of like, whatever, France or Kenya or the US. And then it's for the lender to assess, okay, do I trust this contract? Do I do not? Etc. So yeah, does that make sense?
Yeah. Is that like something that's actually in the works, or still kind of a thought experiment?
It is. It is something we've been, actively thinking about. Internet at Morpho.
Interesting. Okay, and about that, and to start wrapping up, what are some of the big milestones that we should expect from Morpho this year?
So this year, I just hope we help bring more real world use cases that are not into crypto on-chain, and we help them discover the full power of being on-chain, right? And we help them understand that if they have their yield solution that is off-chain and they move it on-chain, they get much better yield. We have them understand that if, they do this, it will be super easy to integrate and they won't have to deal with like a clunky API, but it's like a half a day integration for their engineers. And finally have them understand that if they have the distribution, they are the king and they don't have to rely on TradFi anymore. They can actually own their own financial infrastructure and they can rely on DeFi and blockchains to do that. Yeah.
Awesome. So what's kind of the end goal? Like Morpho teaming up with fintechs to overcome or like take over finance?
Well, I think, so a few things. Morpho wants to be the internet protocol for financing, right? Anybody that has an excess of capital that wants to generate yield should be matched with someone that has a need for financing, right? In the most efficient way possible through Morpho, right? As part of this, there is this disruption that is needed, right? And I think the game plan is really technology is eating the world, and fintechs first disrupted distribution. And DeFi is disrupting infrastructure. And there is a very natural wedding to happen between the DeFi world and the fintech world in order to actually say, hey, by the way, all those fintechs that had amazing distribution that was plugging all of this into the TradFi businesses, we're actually gonna now switching to our own infrastructure. And then TradFi looks at this and is like, oh, we need to come on chain as well, because otherwise we're gonna lose, all the distribution that we used to have. And all of a sudden, everybody that used to operate into black box, with like pretty fat margins, to be frank, end up operating in an open environment where competition is actually fierce and where the value accrues to the edges of the network, which is the consumer, as opposed to like in a centralized backend of a banking infrastructure. And that's really what excites me about DeFi and about crypto in general, is like, how do we essentially take all the value at the center of the financial networks and how do we bring it to the edges?
Totally. Right? It seems like such an ambitious and kind of, like really long-term view for DeFi, but to me it's been exciting to see some of the biggest fintechs actually using crypto in, this past few months with like Robinhood announcement yesterday, and we had, Stripe, PayPal, and so on. So it's like, we're actually starting to see a glimmer of that future that you described. Yeah,
awesome. Yeah, we just like, in the past 3 weeks, we integrated like with 5 or 6 different fintechs, like from Lemon in like Argentina to like Deblock in France and a bunch of others. And it's really happening. It's really exciting.
It is happening.
Yeah.
Awesome, Paul. Thank you so much for joining me. This was amazing.
Likewise.